Imagine you invested $1,000 in Carvana back in 2018. How much would that investment be worth in March 2024? Well, the answer is a whopping $2,116. That's an increase of 112% from the initial investment. An impressive 16% annual growth rate. Now, isn't that something? But what's the secret behind this growth? What's the magic formula that has allowed Carvana to reward its investors so handsomely? To answer these burning questions, we need to take a deep dive into Carvana's financial performance. We need to analyze their revenue, profit margins, net profit, assets, liabilities, and operational efficiency. This will give us a comprehensive understanding of what's driving Carvana's stock prices and how sustainable this growth is. So, buckle up and get ready for a thrilling journey through Carvana's financial landscape. To understand why, we need to review Carvana's financial performance. Carvana's revenue in 2023 was a whopping $10.8 billion. From 2018, the annual compound annual growth rate, or CAGR, was a hefty 40%. This is a significant leap from the early days, and it speaks volumes about the company's strategic direction and market acceptance. Let's break it down year by year. Between 2018 and 2019, there was a staggering 95% growth in revenue. The momentum continued into the next year with a 44% increase from 2019 to 2020. The following year, 2020 to 2021, saw an exceptional rise of 129%. However, the growth did slow down a bit in the subsequent years, with a 6% increase from 2021 to 2022, and a 21% decrease from 2022 to 2023. But let's not get hung up on the decrease. The overall growth trajectory is quite impressive, considering the relatively short period. The fluctuation in the later years can be attributed to a variety of factors, such as market saturation, increased competition, or even external factors beyond the company's control. It's also important to consider the composition of this revenue. 70% of it came from retail vehicle sales, 23% from wholesale sales and revenues, and the remaining 7% was attributed to other sources. This shows a well-diversified revenue stream, which is an excellent sign of a healthy business model. So, what does this all mean? Well, it paints a picture of a company that has experienced rapid growth in a short period. It's a company that has seized opportunities in its market and has successfully diversified its revenue streams to ensure stability and sustainability. But as we all know, revenue is only one side of the story. It's crucial to also consider the profit margins, which is what we'll delve into next. So, the revenue tells a story of impressive growth, but what about profit margins? In 2023, Carvana's gross profit margin was 17%, compared to a 5-year average of 13%. This is a significant improvement, and it shows that the company is becoming more efficient in turning its revenue into profit. The gross profit margin, as you may know, is the percentage of total sales revenue that the company retains after incurring the direct costs associated with producing the goods and services sold. Now let's take a look at the net profit margin. In 2023, Carvana's net profit margin was 5%, compared to a 5-year average of -3%. This is a remarkable turnaround. The net profit margin is a key profitability metric for a company. It represents what percentage of each dollar of revenue a company keeps as profit after accounting for all expenses. So, what do these figures tell us? They indicate that Carvana is becoming more profitable and efficient. But how do these numbers compare to the industry averages? Well, the average gross profit margin for the automotive retail industry is about 15%, so Carvana is performing slightly better than its peers in this regard. On the other hand, the industry average for the net profit margin is around 2.5%, which means Carvana is outperforming the industry average by a good margin. However, it's important to note that these figures vary widely among different companies in this industry, primarily because of differences in business models and operating efficiencies. Now you might be wondering why the net profit margin is significantly lower than the gross profit margin. This is because the net profit margin takes into account all operating expenses including overheads, interest and taxes, while the gross profit margin only considers the cost of goods sold. While the profit margins are improving, the net profit for 2023 tells another story. Despite the positive profit margins, Carvana's net profit was just $500 million. This is the first time the company has turned a profit since 2018, a positive sign, but it also shows there's room for improvement in the company's bottom line. So, as an investor, these are factors you'll want to keep an eye on. In 2023, Carvana's net profit was $500 million, the first year of positive net profit since 2018. Let's ponder on the significance of this turning point in Carvana's financial journey. A positive net profit is a strong indicator of a company's financial health, and it's a milestone that every business strives to achieve. It shows that the company's revenues are more than covering its costs, which is a sign of efficiency and good management. But what does this mean for Carvana's future? Well, the first year of positive net profit is often seen as a breakthrough moment. It's a signal to investors that the company has not just survived the startup phase, but also moved beyond it into a phase of sustainable profitability. It's a sign that the business model is working, and that the company is on the right track. However, we should also consider the broader context. The year 2023 was a challenging one for many businesses, with global economic uncertainties and the ongoing impact of the pandemic. Against this backdrop, Carvana's achievement is even more significant. It shows resilience and adaptability, qualities that are highly valued by investors. But let's not get ahead of ourselves. A single year of positive net profit is a great achievement, but it's not a guarantee of future success. The business environment is constantly changing, and companies need to keep adapting and innovating to stay profitable. For Carvana, the challenge will be to build on this success and maintain its profitability in the coming years. To do this, the company will need to focus on improving its operational efficiency, expanding its market share, and continuing to innovate in its services and business model. If it can do these things successfully, then the future looks bright for Carvana. But of course, the net profit is just one piece of the puzzle. To get a complete picture of Carvana's financial health, we also need to look at the company's assets and liabilities, its cash flow, and its operational efficiency. Positive net profit is a good sign, but what about the company's assets and liabilities? In 2023, Carvana's total assets were $7.1 billion, compared to $8.7 billion in 2022. This marked a significant decrease. But what does this mean in terms of Carvana's financial health? Well, let's dig into it. Total assets are a combination of both current and non-current assets. Current assets are those that can be converted into cash within a year, and non-current assets are long-term investments that can't be easily liquidated. The reduction in total assets might imply a decrease in inventory, receivables, or cash reserves, indicating a leaner operation or possibly a sale of long-term assets. Now let's take a look at the liabilities. The net assets in 2023 were negative $400 million, compared to negative $1.1 billion in 2022. The decrease in net liabilities suggests that Carvana has been able to pay down its debts, which is a positive sign for the company's financial stability. The equity to total assets ratio in 2023 was negative 6%, compared to negative 13% in 2022. While still negative, this improvement shows that Carvana is gradually reducing its financial leverage and moving towards a more balanced capital structure. Now let's discuss some key financial ratios. The current ratio, a liquidity ratio that measures a company's ability to cover its short-term obligations, was 2.2 in 2023, compared to 1.77 in 2022. This increase suggests that Carvana's short-term financial health has improved. The quick ratio, which is a more stringent measure of liquidity, was 1.4 in 2023, up from 1.04 in 2022. This implies that Carvana has become more capable of meeting its immediate obligations using its most liquid assets. In summary, despite the decrease in total assets, Carvana's financial health appears to be on an upward trajectory, evidenced by the reduction in liabilities and improvements in key financial ratios. While the financials are looking up, let's not forget about the operational efficiency. In 2023, Carvana's operating cash flow was $800 million, and its free cash flow was $700 million. These figures highlight the company's ability to generate cash from its core business operations. Now, let's delve into some crucial metrics of operational efficiency. In the same year, Carvana's inventory days stood at 63, up from 56 in the previous year. This indicates the average number of days that items stay in inventory before they're sold. On the other hand, the company's receivable days were 10, up from 8 in 2022, signifying the average number of days it took to collect payment after a sale. These metrics give us insight into the company's management of its inventory and receivables, both critical aspects of operational efficiency. So there you have it, a comprehensive analysis of Carvana's financial performance. Don't forget to subscribe and let us know which businesses you want us to analyze in the upcoming videos.